We are in conversation with Mr. Jayant Davar, MD of Sandhar Technologies, a very well diversified auto ancillary and engineering company. Of course, now they are also pouring in electrical components as well via a subsidiary, Sandhar Auto Electric Solutions. Jayant, good afternoon. Thank you so much for your time. I was looking at your revenue breakup very nicely. Diversified 58% two wheelers, but you have a good share of passenger vehicles, CVs, others, etc. On a blended basis, what kind of growth visibility can you share with us 1 to 2 years far out?
Hi, good morning or good afternoon. Thank you for having me. While I will not be able to give you a forecasted for the entire year, what I can do is to establish that we've grown reasonably well in the last couple of years, and I don't see any reason why, with the investments that we've made in the last few years, there should be any disruption to the growth that we've had, whether in terms of top line or bottom line. So the year looks pretty solid in that sense.
Not looking for absolute numbers, but just a flavor. When you are talking to your clients, both India, overseas, are you getting good conversations for inquiries going forward? Let's talk about your the wholly owned subsidiary Sandhar Auto Electric Solutions, which is just I'm sure I think it's due in July 2024, which is, I'm assuming it may have already started. How big can this business become going forward?
Well, at this point of time, it's actually crystal ball gazing, because it all depends on how the EV manifestation happens within the Indian automotive industry. The largest part of our automotive solutions in terms of electrical vehicles are biased towards two-wheelers. And while there is a lot being said about how ingressed they are going to be in the Indian market, the jury is still out. However, we do believe that with our contribution in terms of wallet to a motorcycle or to a scooter, could be anywhere between 8 to 10,000 rupees per vehicle. One would imagine that if the percentage of vehicles go up, that particular segment of our business could be substantial.
Sure, Mr. Davar. Good afternoon. This is Vinny joining in the conversation as well. What we also want to know is in terms of the locking and vision system, which around contributes now 25% of your revenue. What is it that you are expecting from this segment in terms of a growth, and how do we see this contribution changing?
Vinny, I see this to be the most bullish area of our manufacturing and our product lines, especially with the changeover that's happening from pure mechanical locks to smart locks going ahead. The launch of this on a mass scale in India is likely to happen in October and November, and we would be the first ones off the block for this mass adoption that happens in two of the largest OEMs in the country. Now, in terms of explanation, a mechanical lock typically ranges from about 350 rupees to 500 rupees per lock set, while a smart lock goes anywhere from 3,000 rupees to 5,000 rupees plus even beyond. So therefore, with that happening, we could be looking at a revenue from the same product line bringing in anywhere between 8 to 10 times that of revenue as the adoption happens on a mass scale. So that is a big bullish thing for us as a company, and a changeover to new technology in the Indian context.
Jayant, can you help us understand a little more on that one? This is one particular category, lock, but what we also gather is that the electrical components are smartening above various other features in an average vehicle is actually increasing. So the component share is completely going through the roof. Will your company be a very big beneficiary of this trend?
I would imagine so. So premiumization is a huge thing that's gone off in the Indian case scenario. Some of it is on account of the government mandates. If you look at anything that has to do with emission controls and so on and so forth.
I just want to broadly understand going forward, what are the new contributions coming in on the revenue side? Because that itself will also give you some additional growth.
Oh, yes. So while the electrical vehicle is still, like I said, out to see where it goes, we haven't taken it into our business plans per se in terms of substantial revenue. Of course, that will kick in and that will be a bonus. But in terms of long and medium and short and medium term, the onset of smart locks itself would be huge. The second is the capacities that we had put up in the last 3 years, where we had spent almost 600 odd crores. That is now getting more active and the utilization content is going up. We expect that to continue. So as a company, we would see our margins improving. We've seen that improve now over the last 3 years, and we see no reason why that should stop. And like I said, with the capacities now being utilized to a higher level and optimized to whatever degree it can, we would continue to see the increase in revenue despite whatever sales the industry goes through. So if the industry goes through a bigger jump, of course, we get the benefit. But at this point of time, we sit very comfortably with what is in store for us in the short and medium term.
Your margins are actually improved quite a bit on a yearly basis and even in Q4. So yearly improvement as well as Q4. What trajectory are we talking about here? Now your margins will settle in range wise?
In our kind of business, I would imagine the optimum margins are about 12.5, 13 odd percent. We are still far away from there, but we see a gradual improvement to those levels as we kind of reduce the continuous capacity expansion and capital expenditure. Now that most of the capital expenditure has been done, we would imagine that margins will continue to grow in the future times.
Subsidiaries which are up till now weighing in on your overall numbers have turned around, be it the helmet company, some other joint venture company as well, Sandhar, Hansung turned a bit positive. Can you talk about all these as well and the contribution it can overall have going forward?
So the good news is that all the joint ventures have now become positive. If there has been any gap, that has been on account of some foreign exchange fluctuations. But besides of that, we are very happy that all joint ventures are positive. And the drag that there had been on our profit and loss account over the last 4 to 5 years, that particular season is over. And we should now start reaping the benefits to the bottom line coming from these joint ventures as well. Yeah, so from the perspective of guns, I think all of them are blazing right now. And we are quite confident of being able to outperform our budgets that we've taken.
Also, in terms of the debt reduction plan that the company has, where do you see that headed? FY26, FY25 and 26, what's the plan there?
Well, we are not so concentrated on debt reduction. What we are trying to do now, you see, expansion has to happen. We can't really sit back and say we are not going to look at ourselves going forward 5 years and 10 years. So a certain amount of capital expenditure will continue. But that is not really prime on the agenda. What we have to make sure is that we are in a comfortable position to be able to service the debt that we have. And we are very, very comfortable in that situation right now. However, we do see a reduction in debt over a gradual period of time. The important thing is to concentrate on utilization of capacities, optimization of revenue and profitability at this point of time.
Jayant, if you could help us understand, there is a section of the street which believe that on the top line front, annualized now with new capacities coming on stream, joint ventures coming back, combined your growth can be much higher than 30-40%. Is there a fair estimate?
Well, to give you an answer there, well, I would not give you any numbers, except that joint ventures really don't come into our revenue stream. It's only the profitability that shows up in our balance sheets. The joint ventures are separate companies, therefore the revenue is not added line to line. in terms of the company, you've seen the growth that we've done in the last 2 years, and I see no reason why that should slow down from our understanding.
All right, Jayant, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you for having me. Thank you
That
very
was
much.
Jayant Davar talking about good growth prospects, because bulk of the capex has already happened and it will start contributing. In fact,
if you like this video, then like, share and subscribe to ET Now.